Linda Carver, 71, from Jacksonville, wrote a $4,682 property tax check on January 22, 2026, and it wiped out the cash she had set aside for medicine, groceries, and the transmission repair on her 10-year-old Toyota. 3 blocks away, Howard Mills, 73, cut his bill by thousands because he filed for senior relief Linda had never been told existed, and the shock on her face when she found out was the kind that keeps people up at 2 o'clock in the morning. No, turning 65 does not automatically erase your property tax bill across America in 2026. But yes, once you pass 65, there are legal exemptions, freezes, reductions, and deferrals buried in state and county systems that can slash what you owe, and in some places reduce part of the bill to zero if you file the right form before the clock runs out. That is the trap. Most seniors hear one sentence from a neighbor, a cousin, or a Facebook post and assume there is one national rule. There is not. Property tax relief is a patchwork of county assessors, state statutes, homestead filings, income limits, occupancy rules, local option votes, and filing windows that can close long before your bill lands in the mailbox. If you are over 65 and own your home, this matters more than most bank fees, most credit card rates, and most so-called retirement hacks people waste time talking about online. One missing exemption can cost you $1,500 in Idaho, freeze nothing in Illinois, block a 50% assessed value break in New York, or leave a Texas school tax ceiling sitting unused while you keep paying year after year. I am going to show you where seniors really stop paying part of these taxes, where they only postpone them, and where one wrong assumption turns relief into a lien against the house. Start with the enemy. It is usually not the IRS. It is the local assessor, property appraiser, appraisal district, tax office, or county board applying rules you were expected to know without ever being clearly told. In Texas, that means Tax Code Section 11.13 and a homestead application. In Florida, it means local option senior homestead rules under Section 196.075. In New York, it means Real Property Tax Law Section 467. One code section can change your bill. One missed deadline can keep it high for another year. First value bomb. If you turned 65 after January 1st, you may still qualify for relief for the entire year in some jurisdictions, including Travis County's explanation of the Texas over 65 homestead exemption. Most homeowners never even ask. They assume the mortgage company or escrow account will catch it. It usually will not. And there is a second trap sitting behind the first one. Some programs that sound like exemptions are not exemptions at all. They are deferrals or postponements, which means the tax is not gone, the debt is still alive, and if you do not understand that difference, your children can inherit a surprise bill later. I will show you the most dangerous version of that before we hit the midpoint. Case 1. The Texas School Tax Ceiling. Frank Nolan, 68, from San Antonio, kept telling himself his tax bill would settle down once he crossed 65. It did not. In 2025, he paid $5,940 on his homestead, and by early 2026, he was still paying increases because he had never filed the over 65 exemption that triggers the school tax ceiling and the additional senior homestead break. Texas is one of the clearest places to start because the law is direct even if the process is not. Texas Tax Code, Section 11.13 provides a residence homestead exemption, and local officials explain that once you qualify for the over 65 homestead exemption, the school taxes on your house generally stop increasing above the ceiling set in the year you qualify, unless you add taxable improvements beyond normal repairs. That is a powerful protection. It is legal. It is real. It does not apply by magic. Source. The action step is plain. File Texas Form 50-114, the Residence Homestead Exemption application, with your appraisal district, and do not assume the lender has anything to do with it. Search your county appraisal district site, verify your mailing address, and make sure your ID matches the homestead address. If you moved recently, transferred title, or placed the property into a trust, check the ownership details before you file because paperwork mismatches are where these claims start bleeding out. There is another edge here. Texas Comptroller guidance says the general deadline for filing an exemption application is before May 1st, and several county offices tell homeowners to get it done by late April if they want the bill corrected in time. That matters because seniors often wait until the tax statement arrives, which is late. By then, you can spend months chasing a correction that should have been automatic only in your mind, not in the system. Source: wait. It gets worse. A lot of retirees hear tax ceiling and think, no more property tax. That is not what the ceiling means. It limits school taxes on the homestead once you qualify, but other taxing units may still apply. And if you add a new room, a new garage, or another fixed improvement that raises value, the ceiling can be adjusted. Frank learned that after putting in a $19,000 addition for his daughter and grandson. The bill did not vanish. The protection just got more technical. If you want a fast self-check, pull last year's and this year's bill and compare the school tax line, not just the total. Then call your appraisal district and ask whether your over 65 exemption is active and whether a tax ceiling was established in the year you qualified. If it was not, that is where your money may be leaking. Has your county ever sent you a bill that made no sense? I would pay attention to that because hundreds of older homeowners discover they were eligible for relief only after comparing notes with neighbors, and by then they are reacting instead of protecting themselves. Case 2. The Florida senior break that exists only if your county or city chose to offer it. Nancy Ruiz, 77, from Palm Beach County, assumed Florida gave every homeowner over 65 the same extra senior homestead benefit. She had heard the phrase on local TV, wrote it down, and then forgot about it until her 2026 estimate came in almost $2,100 higher than she expected. Her mistake was common. Florida does offer senior-related homestead benefits, but some of the most valuable ones are local option programs, which means your county commission or city government had to adopt them first. Florida's PT 110 guide explains that certain property tax benefits are available to persons 65 or older, and the additional homestead exemptions tie back to Section 196.075 of the Florida statutes. One version can provide an exemption of up to $50,000 for an eligible person 65 or older whose household income does not exceed the income limit. A second version can equal the assessed value of the property for long-term low-income seniors if the home's just value was less than $250,000 in the first year of application, the owner maintained permanent residence there for at least 25 years, and the income test is met. That is the sort of line buried in a PDF that changes someone's retirement budget. Source. For 2026, Florida's Department of Revenue lists the adjusted income limitation for these additional homestead exemptions at $38,686. Read that again, not $80,000, not whatever Social Security pays. The number is specific, and the rule applies only to the county or city millage when a local ordinance exists, not to school district millage or every other taxing unit on the bill. That is why two seniors on the same block can hear the same rumor and get very different outcomes. Source. The forms matter. Florida points seniors to Form DR-501 and Form DR-501SC, and the filing usually runs through the county property appraiser's office, not some state office in Tallahassee processing everything for everyone. The move for you is simple. Call the county property appraiser, ask whether your county or municipality adopted the additional senior homestead ordinance, ask whether you qualify under the 2026 income limit, and ask which supporting documents they require for household income proof. Some offices are stricter than others about documentation. That part is rarely explained clearly. Case 3. The New York senior exemption people describe as automatic, even though it is nothing of the kind. Doris Kane, 74, from Syracuse, had owned her house for 19 years and still never filed for the senior citizens homeowners exemption because she believed her assessor would see her age on the records. That assumption cost her. New York's Real Property Tax Law Section 467 allows local governments and school districts to grant a reduction on the amount of property taxes paid by qualifying senior citizens, often up to 50% of assessed valuation, but it is a local option and it comes with ownership, residency, and income rules that are far from casual. Source: the law generally requires owners to be 65 or older, although married couples or siblings can sometimes qualify if one owner meets the age requirement. The property usually must be the legal residence of and occupied by the owner, and title typically must have been vested for at least 12 consecutive months before application, subject to exceptions. Income limits are not one national number either. Under the statute, local governments can set an income ceiling up to $50,000, and the structure includes sliding scale options in some cases. That is why one county can feel generous and another can feel cold. Source: the form you need is RP-467, Application for Senior Citizens Exemption, not a phone call, not a note, not a verbal conversation at the clerk's desk. A form. If you live in New York and you have never seen it, pull it up, read the instructions, and ask your assessor whether Social Security is counted the same way in your locality, because municipalities can handle parts of the income definition differently. Tax professionals still argue over how clearly some local offices explain these distinctions, which is one reason seniors miss them. Source: by now you can see the pattern. The phrase, legally exempt after 65, is true only in pieces. It can mean an exemption in one state, a ceiling in another, a reduction in a third, and absolutely nothing if your local unit never adopted the program or if you never filed. That is not an accident. Bureaucracies love rules that look public and feel hidden. Midpoint. This is the catch that changes the whole picture. Everything I just told you about paying less today comes with a second question, and this is where seniors get blindsided. Are you reducing the bill, freezing part of the bill, or only postponing the bill until later? Those are not the same outcome. They are three different legal animals, and when people mash them together under the phrase, "I don't have to pay property tax anymore," that is when families get hurt. Arthur Bell, 79, from Fresno, stopped paying current year property taxes after hearing about California's property tax postponement program from a neighbor. He thought the state had exempted him because he was older, disabled, and on a tight budget. What actually happened was a deferral secured by a lien against the property. The program can be a lifeline. It is not free money. California's state controller says the property tax postponement program allows eligible seniors, blind homeowners, or homeowners with a disability to defer current year property taxes on a principal residence if they meet conditions including at least 40% equity in the home and annual household income of $55,181 or less. For the 2025 to 26 cycle, applications were available in September 2025. Filing opened October 1st, 2025, and closed February 10th, 2026. That deadline is brutal if you find out in March. Source here is the reframe. The best-sounding relief program is sometimes the one you need to treat with the most caution. Exemption means relief by law. Freeze means value protection against future increases. Reduction means the bill gets cut under a formula. Deferral means you are borrowing time, and time charges interest or creates a future payoff event when the home is sold or transferred. If any of what I just said made you stop and think, and it should, tapping the like button takes 2 seconds and helps this reach other seniors before another filing window quietly closes. Texas tells the same story in a different accent. Travis County explains that if you qualify for the age 65 or older exemption, you may defer or postpone paying property taxes on the home as long as you live there, but the taxes accrue 5% annual interest until the deferral is removed. When the home is sold or ownership transfers to heirs, the taxes and accrued interest become payable. That sentence should be printed in 6-inch letters. It usually is not. Source: I know this can feel heavy. You spent decades paying for a home, and now the rules start sounding like a maze built by people who never worried about their grocery bill. Stay with me, because the second half is where we separate the programs that save cash right now from the ones that only move the pain into the future, and I have a red flag checklist coming that could save you from signing the wrong paper. Case 4. The Idaho reduction that a lot of people miss because it sounds too small to matter until they do the math. Helen Brooks, 76 from Boise, figured a state reduction program worth a few $100s was not worth the trouble. Then she learned Idaho's property tax reduction program could reduce property taxes by $250 to $1,500 on a primary residence and up to 1 acre of land. For someone living on Social Security and a modest pension, that is not pocket change. That is a winter utility bill, a prescription refill, and the difference between carrying a balance on a credit card or not. Source: Idaho says you might qualify in 2026 if your total 2025 income, after deducting medical expenses, was $39,130 or less, and you were 65 or older, blind, widowed, disabled, a former POW or hostage, or a qualifying child under 18. You must own and live in the Idaho home as your primary residence before April 15, 2026, and the property must have the homeowner's exemption. You also have to apply every year between January 1st and April 15th. Miss the date, miss the break. That is the rule. Source: There is a lesson inside that. Some of the best senior property tax relief programs do not erase taxes entirely. They trim the bill enough to protect cash flow. That matters because cash flow keeps retirees out of overdrafts, payday-style installment traps, and forced withdrawals from savings at the worst possible moment. Case 5. Colorado's rule rewards seniors who stayed put. Calvin Moore, 70, from Pueblo, spent 12 years in the same house and never realized that was the very fact that could qualify him for relief. Colorado's senior property tax exemption is available when the state budget allows reimbursement, and the state explains that 50% of the first $200,000 of actual value of a qualified applicant's primary residence is exempted. That is not a rumor. That is a statutory benefit with teeth. Source: The conditions are strict. You must be at least 65 on January 1st of the year you apply. You or your spouse must own the property for at least 10 consecutive years before January 1st, and you must occupy it as your primary residence for at least 10 consecutive years before January 1st. Applications should be submitted by July 15th, with late filings through August 15th, but no appeal rights after July 15th. That last detail matters because some seniors think late is late and others think late is fine. In Colorado, late may still be accepted, but your leverage on appeal disappears. Source: Most people skip this part because it sounds technical. Do not. Relief programs often care less about your age than your paper trail. Ownership dates, voter registration, occupancy proof, trust language. If your home is held in a trust, or if one spouse moved to assisted living, the exception rules may help you, but you have to ask with documents in hand. Case 6. Illinois, where exemption and freeze sound similar but do very different work. Marjorie Ellis, 72, from Rockford, believed the senior citizen's homestead exemption would lock her property taxes in place forever. It did not. Illinois says that annual exemption reduces equalized assessed value with a maximum reduction of $8,000 in Cook County and counties contiguous to Cook County, or $5,000 in all other counties. Helpful, real, not the same as a total stop. Source: Then there is the Low-Income Senior Citizens Assessment Freeze Homestead Exemption, often called the Senior Freeze. For taxable year 2026, payable in 2027, Illinois lists household income of $75,000 or less as part of qualification, and applicants must file Form P-TAX-340 each year with the Chief County Assessment Office. Notice the word freeze. It freezes the property's equalized assessed value at the base year value. That does not always mean the tax bill itself cannot move, because rates and other components can still change. Seniors here freeze and think, stopped. The paperwork says something more narrow. Source: if you have made it this far, you are exactly the kind of homeowner who refuses to sleepwalk through these rules. Subscribing means you will catch the follow-up I am releasing on escrow shortages, tax sale notices, and the bank account mistakes that start after seniors overpay a bill they never should have paid in full. That next piece connects directly to what you are hearing right now. Red flag checklist. Pause and check these tonight. 1. Your property tax bill still shows no senior exemption code even though you turned 65 months ago. 2. Your mortgage servicer raised your escrow payment but never asked whether you filed a homestead or senior application. 3. Your county says local option, and nobody in the office will answer with a straight yes or no about whether the ordinance exists. 4. Your relief depends on income, and you have not checked how Social Security, medical deductions, or household income are counted. 5. Someone told you deferral and exemption mean the same thing. 6. Your home sits in a trust, and you never asked whether the trust structure affects eligibility. 7. You are counting on your heirs to figure this out later. That last one is how families walk into liens they never saw coming. There is also a tax return angle most homeowners miss. IRS publication. 530 says real estate taxes can be deductible if they are assessed uniformly for general community or governmental purposes, but charges for services to specific property or people are not deductible as real estate taxes. Trash fees, water use charges, a flat mowing charge from the local government, those are different animals. The overall SALT deduction limit is listed at $40,000, with special reductions at higher modified adjusted gross income levels. That means if you still pay part of the bill, you need to know what portion is actually tax and what portion is a fee. Source: depending on your county, the hardest part is not the law itself, it is the language. One office says exemption, another says credit, another says benefit, and another buries the rule 3 clicks deep under taxpayer services. Some assessors explain the programs cleanly. Others make you feel like you are interrupting their day by asking. That difference is real, and it changes outcomes even when the statute is the same. Now connect the dots. Texas teaches you that age can trigger a school tax ceiling, but only after a filing. Florida teaches you that age alone means nothing if the local ordinance was never adopted or your income is too high. New York teaches you that a powerful exemption can exist in law while still depending on residency, ownership length, and a form many seniors never see. Idaho teaches you that a modest reduction can matter more than a flashy promise. California and Texas teach you that postponement is not forgiveness. Illinois teaches you that a freeze may freeze value, not the entire bill. Colorado teaches you that the house you stayed in for 10 years can become your advantage only if you claim it. That is the thesis. The system was not built to hand you relief because you reached a birthday. It was built to make you ask for it, prove it, renew it, and lose it if you miss one line or one date. Use this Monday morning checklist. Monday, pull your last 2 property tax bills and circle every line item that changed, especially school tax, county tax, city tax, and any special assessments. Tuesday, call your county assessor, property appraiser, or appraisal district and ask 3 direct questions. What senior relief programs exist where I live? Which of them are exemptions versus deferrals? And which forms are due next? Wednesday, verify your deed, homestead status, trust status, and mailing address match the home you occupy. Thursday, gather proof of age, proof of occupancy, prior year income records, and any medical expense records if your state's program uses income after deductions. Friday, file the form or schedule the appointment. Not next month. Not after the next bill. Friday. If you want outside help, AARP Foundation's Property Tax Aid, says it offers a free resource that helps homeowners and renters apply for property tax relief, and it reports helping people over 50 secure more than $10 million in relief since 2019. For seniors who freeze up when the forms start piling up, that kind of guided screening can be the difference between action and delay. Source: there is one more connection nobody talks about. Property tax relief is not just about the bill, it is about bank safety. When a retiree overpays a tax bill they could have reduced, that money often comes from cash reserves, a CD break, a card advance, or a larger IRA withdrawal. One bureaucratic miss can trigger overdraft fees, tax consequences, higher Medicare premiums after income spikes, or simply fewer months of breathing room. The property tax office makes one decision. Your whole household budget pays the price. Go back to Linda in Jacksonville. After she found out her county handled senior relief differently from what she had been told, she spent 47 days calling offices, gathering income records, and correcting assumptions that had cost her real money. She did not become automatically exempt at 65. She did learn that parts of her bill could be reduced lawfully, that some benefits depended on local adoption and income limits, and that waiting for the system to volunteer help was the most expensive choice she had made all year. Frank in Texas finally filed his homestead paperwork and established the over 65 protection he thought had already been there. Doris in New York filed RP 467 after nearly 2 decades of paying more than necessary. Helen in Idaho stopped treating a 4-figure reduction like a minor win. Calvin in Colorado realized his 10 quiet years in the same home were worth more than any glossy mailer promising retirement tricks. Arthur in California learned the hard way that postponement buys time, not freedom. You do not need perfect mastery of every rule in every state. You need a cold understanding of one fact. Age does not activate relief. Action does. That is why this matters so much. You spent 30 or 40 years paying for the roof over your head. Do not let a form you never filed, a deadline you never saw, or a word you misunderstood tear a hole in the budget you built to protect yourself. In the next video, I am covering the escrow shortage letters, tax sale warnings, and mortgage servicer mistakes that hit seniors right after a property tax bill spikes, and once you see how those notices work, you will never look at a monthly payment increase the same way again. That one is coming next. Paperwork beats panic.